All right, Chris, now that people have seen you on the big screen, why don't you kick us off with introductions?
Yeah, thanks, John, and thank you for having us and putting this together. It's a pleasure to be here. I'm Chris Geyer. I'm a managing director with Hennepin Partners. We are a Minneapolis-based, sell-side focused, what I'd call investment banking boutique, about 40 professionals. We do 20 to 25 transactions a year representing sellers primarily. Deal values kind of in the 20 to $200 million range is our typical transaction size. And we were founded really by a group of folks that came out of much larger banks as I did in my career, and really wanting to take that kind of big multinational global investment banking expertise and bring it into the lower middle market and use it to represent families and founders selling their businesses.
We'll keep going down the line then, Mark.
Wonderful. Hi, everybody. My name is Mark Phillips. It's just great to be here. And I am the founder and managing partner of an organization called 11 Tribes Ventures. So I am one of those third parties, I guess, guilty as charged. I started the firm really out of my own entrepreneurial experience. I started a company while going through business school at Chicago that, after building it for about 3 years, ended up falling apart, which is quite a story that I'm sure many of you have experienced for yourselves. But as that company fell apart and I was there kind of holding the ashes of my business, while the business failure frustrated me, the thing that scared me was how much I had allowed what I describe as the founder outcome to affect the things in my life that I care the most about. And I think this theme of competence and character that the group here is sharing today is so important, and I've experienced it myself. As I looked at my emotional, mental, physical, and spiritual health at the end of my business, I didn't like what I saw. And so coming through that and working through a lot of things in my own personal life, I became very passionate about this journey of entrepreneurship, right? What is required of a founder to take a business from 0 to 1, not necessarily from a business acumen perspective, but as a leader and as a family member and as someone that cares about their role in the community and the like. And so we started a firm, 11 Tribes, with that thesis of what would it look like if a venture capital firm invested as intentionally into what we call the founder outcome as we do into the business outcome. And I think it really speaks to so much of what we have heard so far today, which is these things need to be worked on well before the exit of the company, right? And so we encourage the founders we work with to establish rhythms of rest, to find ways to care for themselves, to care for their families as they continue to build these businesses. I think an alarming conversation that I've had are with founders who sold their businesses for hundreds of millions of dollars. They never have to work another day in their life. But they shared with me that the day after they sold their company was the worst day of their life because they had felt that everything would be there waiting for them, but they chose to allocate all of their time and attention to their business. And they were so wealthy that all they had was money. And so we are a venture capital firm now that invests into businesses to maximize for both founder and business outcomes. We invest in companies doing anywhere from $500,000 to $3 million of revenue, so it's very early for sure. But we help them ideally 10x that business over the course of 5 to 7 years, and then hopefully talk to a number of the gentlemen sitting up here to help them exit that company and figure out what comes next.
Terrific. Thank you. Nathan.
My name is Nathan Viehl. Thanks for having us. I'm a partner at Thompson, Coburn. We're a law firm of about 450 attorneys. We're a national firm, but most of our presence is in the Midwest. I work out of the Chicago office down the road here. My practice is M&A defined, very broadly. But most of my day is, negotiating the sale or the purchase of businesses. But we also do, and I support, all the things that businesses need from the time that they're being founded to the time where they're scaling, ultimately with an eye to an exit and a liquidity event. So we pitch in on just about anything along that process, and I think with a particular focus on what it's going to look like when you go to sell that business.
Terrific. Well, we heard for a couple minutes there a segment with Chris, so I do encourage going back, listening to that full episode. We broke down the process quite a bit. You talk about 3 different parties between the investment banker, the accountant, and the attorney on the transaction. So we'll start with you, Nathan, then too, as one of those 3 critical pieces. Help help individuals understand the difference between a deal attorney versus their general counsel versus their estate planning attorney versus like your area of expertise. What is that? And then we'll come into the setup that makes the process go as efficiently as possible.
Absolutely. When you operate your business day to day, there are probably all kinds of risks that make perfect sense for you to take and that you should take and be comfortable taking. When you go to sell, those are going to start to look a lot different, and you really need advisors and an attorney who can help you prepare for that with an ultimate view for how your buyer is going to look at your business. So, you know, a business owner might come to me as an example and say, hey, like, one of the best things about my business is my main supplier is, you know, Jim Bob, and he and I went to middle school together, and we're best friends, and we've just been, you know, doing deals, and our relationship is the key to this whole business. That's not always an asset. No, that's not an asset to a buyer. That's an issue, and it might be in your and Jim Bob's interest to put that in writing and make sure we understand, you know, exactly how these businesses will operate when they're ultimately transferred. Which, as John put, you know, there's always an exit event of some kind, especially when you're just kind of relying on one person. So. You know, I think you truly need someone who goes through that process on a regular basis, has seen how those issues play out between a buyer and seller, to help you evaluate and negotiate what is you know the biggest transaction of your life, and a true generalist who might dabble in, you know, real estate and some employment agreements and trust and estates is just not going to have that level of expertise, and they're not going to have the team behind them that you need to execute a deal, because it is that legal process in the last 30 to 60 days is an intense endeavor that requires, you know, a lot of people who are responding and are responsive, you know, from 5 a.m. to midnight.
So we highly encourage getting top talent when it comes to estate planning attorneys in the same way we do on the transaction side. And if you've got great individuals in both, their feelings are not going to be hurt. So if you're concerned about going to a transactional attorney and hurting the feelings of someone else, I'd actually take that as a red flag regarding how that's being approached. The attorneys will be interfacing with one another. They will be collaborating to get the transaction done for you because of all the estate work that would be done leading up to the transaction, but then handing it off and interfacing back with transaction attorneys as well.
And I'll add, often we love collaborating because it turns into a two-way street where we build a lot of relationships that way.
Yeah, and across firms too. It's not the same firm. Mark, you mentioned really early on, so venture capital, right? Small, the money's going in. How soon into the process, as you're looking to make venture investments, are you thinking about what the exit is?
From the moment we invest. And so early on, there's all sorts of different vehicles and formations that entrepreneurs can take to fund their business. But we work with an attorney, very similar to Nathan here, that focuses on how do we structure the company from the get-go to benefit from the tax implications, the liquidity, the potential for structural issues or liabilities that can come with it. So it's a wonderful question, John, and it's really from the moment that we invest. I think one of the things that I'm sure many of you are familiar with that we spend a lot of time focused on is qualified small business stock. And so ensuring that these organizations are, and that has all sorts of caveats that we don't need to get into now, but ensuring that these organizations and these founders are equipping themselves and the shares that they're issuing for their business to benefit from what is really one of the IRS's most attractive tax benefits for business owners. So I think venture as an asset class, quite frankly, has dismissed this conversation a little bit more than they should. I think it's pursuit of growth at all costs, as opposed to let's think about what does it look like to grow sustainably, durably, and profitably. And I think if you take that latter perspective, which in our opinion, of course, is much healthier, structuring the organization and your ownership of that company as a founder from the moment that you start taking third-party money or institutional capital, I think is in the best interest of the company and the founders.
And I think Stephen Covey has us all well-trained, right? So starting with the end in mind. And what is that end? Because you're not looking to hold these forever, right? And that's the interesting perspective that you bring.
And most of the entrepreneurs we work with feel the same way. They don't. It's interesting, the blend of family businesses, and whether you think about startup as a family business. It's, there's nuance there. I think a lot of the folks that we work with are serial entrepreneurs, right? And folks that, hey, once I build this and I get it to a certain level, I'm interested in what comes next. And so I love that comment, John. Thinking with the end in mind, I think, is always a great way to go.
So moving from venture capital, from an investment banking perspective in terms of dealing with strategics and financial buyers, but a little bit further down the maturity cycle, when you're looking at that, Chris, what are you seeing develop and how early are you engaging in the process?
So in terms of how early are we getting involved with the sellers, or?
Yes.
Yeah. I think, we'd like to be involved as your investment banker as early as possible. And so we've all, we've heard a few anecdotes about somebody who has been running their business for years, and, the time comes to sell, and, all right, next week I'm going to hire an investment banker and we're going to go to market. And, that's just not really how it works. And whether it's, working with somebody like an Agora, or working with an investment banker for some period of time before going to market, it's critical. And when you think about how do you maximize value for your business, there's three things that I kind of come back to. One is preparation, one is positioning, and then the last one is competition. And so you need to plan for all those things. The preparation, it could take a month, it could take 6 months, but you don't want to be ever in a position where you're being forced to work on somebody else's timeline. You want to dictate that timeline from the start.
So when somebody's thinking about selecting an investment banker, how should they be thinking? Are all investment bankers the same?
You should hire us. No, there are all different flavors of investment bankers. There are firms that focus on particular markets, particular types of businesses, are very narrow and deep. There are groups that are much larger and broader. And there are, all kind of flavors in between. So I think one of the things that, we tell people is who are going to be selling a business is, even if you're not going to hire us, work with a banker, work with an advisor, because it will, even if maybe you only have 2 buyers that you're planning to go and talk to, having that advocate on your side is critical. I think it's important to talk to different firms, different size firms. We saw in Kip's clip where he talked about, in that situation, they talked to one that was maybe too big, one that was too small, one that was just right. But you want to get a feel for these different types of firms that are out there, and you want to establish chemistry with your banker, because it's going to become, for better or worse, one of the most important relationships in your professional career, at least for somewhere between 6 and 12 months through this exit process, and you're going to get to know them probably all too well.
And spending a lot of time together. Go ahead, you're about to say.
I just wanted to comment on that because I think it's so well said. And what we've seen is, as founders, and that's the language we use, right? The people starting these businesses get to the point of exit. I think there's a bit of an identity issue wrapped up in selling the company. And it's just, I don't think it's valid to think, as the founder of this business, I need to also understand all of the ins and outs of what's required to sell it. And so when you think about a Chris or any other investment bank that you might work with, I just think there's the humility to say, hey, I need help. I need someone to come alongside us and understand what are the nuances of this process to maximize the value of what that founder has built. I think having the humility to have that conversation is super important. And we encourage all the founders we work with at the right time to engage with those service providers.
Go ahead.
I was going to say, and I think from a buyer's perspective, many buyers would prefer there is some kind of investment banking intermediary in the mix, because, trying to work with a seller who doesn't know anything about the process, doesn't know anything about the due diligence process, doesn't know where they can find the right information that the buyer wants. That's what your banker should be doing, and helping you prepare for that, and making the process much more streamlined, both for you and for the ultimate buyer of the business.
Yeah.
So let's decode some acronyms. Teasers, SIMs, right? And then we'll come back to you on IOIs, LOIs, purchase agreements. So start a little bit for the process side of it. What's a teaser? What's a SIM? How does the process work from the banking?
Sure. Yeah. We're good at using these kind of words and assuming everyone knows what they mean. So when you engage an investment banker, work with a banker, and you've done the preparation work to think about how you want to position the business. It's time to approach the market. The first thing you do is you go out with what we call a teaser, which in many cases is a one-page blinded document that doesn't say the company's name, gives enough information to the potential buyer or buyers to determine whether or not it's something they're interested in and want to learn more about. And so you'll send them a teaser along with a confidentiality agreement. If there's interest on the buyer's part in learning more, they'll sign the confidentiality agreement, send that back to us, and then we'll send them a confidential information memorandum or a SIM. Some people call it a SIP, confidential information presentation, and that'll be a much more robust document. Maybe it's 50 pages, maybe it's 75 pages, which covers, kind of from the beginning to end of what the business is all about, both from an operations standpoint, from an end market serve standpoint, your customers, your growth opportunities and prospects, and a financial overview of the business.
And by the time that goes out, you already have NDAs in people's hands, right, and executed. What comes next on the documentation front?
Then once, if your prospective buyers like your SIM, then they want to get into the data room. And in the data room, you're going to start to preview. It's going to be heavy financial information, but you're going to start to preview some of the legal documents. And when you're going through that process, you want to start to present, I think, what I call kind of a pretty picture and a story of your company, because I'm not. I think most good attorneys aren't, so full of themselves that they think they're the most important part of the process. In fact, we're like the least important thing. What's important is your financial diligence. And what you want on the legal side when you're going through diligence is you want to present a good enough of a picture that doubt doesn't start to creep in, and the buyer doesn't start to say, hey, like, what more should I be asking? The finances look amazing, but this area is kind of a mess. What should I be doing here? And once you get through that process, though, assuming you still have a bunch of people interested in your business, you get what's called an IOI. And those are typically completely non-binding, and it's a way to kind of cull the pool and get to some deeper management presentations and further diligence. And the final step is selecting one buyer, which is typically what happens at the letter of intent stage. And I always tell my clients that the only binding thing in a letter of intent is going to be exclusivity. And once you sign exclusivity, your price can only go down. So the goal is always to run a very disciplined and good process. So once you sign that document and we really kick off legal diligence and drafting purchase agreements and disclosure schedules and getting to a closing, we want to make sure you have as much leverage as possible up into that moment when the buyer really starts to kind of turn on their diligence operation.
Now, Mark, you have individuals that are continuing to come to you seeking capital. So you're a buyer in that way, making investments back in. As you're going through some of the information that's coming to you, right? The pitch books that are coming out, the documents that are coming to you, what are you looking for? Because you want to get to quick no's as fast as possible, right? And long yeses. What are you looking for to get to quick no's and just throw it out to get to the good ones?
Yeah, I mean, so much of it is what these guys have spoken to, which is the financial quality of the business, right? A lot of investors will do a quality of earnings. They'll look for certain, as Nathan appropriately alluded to, relationships within the business or suppliers that have risks. Ultimately, it's a function, John, of what's the quality of the financial standing of the business? What are the variables at play that are going to impact the ability for that business to continue producing said results? And do we feel comfortable that this organization is going to allow us to generate the same types of returns moving forward, independent of the business owners' relationships and contributions? So, at this stage, a lot of what we talk about, because we're minority investors, is this kind of the moniker of humble, hungry, and smart. And I think what's important for a business owner that really is looking to exit the business to appreciate is, while their contributions are super important, that financial buyer is really just focused on the financial performance of the company, right? I think culture can be a big component of it as well, and We could talk about that for another 20 minutes, I'm sure. But it's that relationship between the quality of earnings and the really the what's the word I'm looking for? Like the sustainability of those earnings moving forward.
So didn't purposefully not have an accountant on the stage during this time frame, but quality of earnings. Quality of earnings is a thing, right, within the CPA world. And so people use a wide range of different accounting firms. How important is it to the process that someone's engaged with a very capable and maybe even name recognized accounting firm to prepare their financials, to prepare the quality of earnings, to prepare not just somebody that might have been doing their taxes, as buddies early on, going through that. How important is that CPA role?
Yeah, there's a number of firms out there, and some of them are, PwC and E&Y down to smaller firms that specialize in this, but groups that do, these sell-side quality of earnings reports, diligence reports, you see it in almost every process now. It's almost kind of table stakes when you're bringing your business to market, and engaging a group that this is what they do every day, and it's not the guy that does your audit or the gal that does your audit. This is a highly specialized deliverable that will be, as important as the confidential memorandum that you're putting out, because again, it's kind of the financial Bible for your firm, if you think about it that way. And at the end of the day, businesses all look different, but it always comes down to cash flow and growth profile, and those are kind of the two universal truths. And this is all about defending the cash flow piece of the business.
In closing then, final words, we'll go right down the line. We'll start with you, Chris.
Well, I think you've heard it many times, but prepare, start early. There's no time, there's never too early to begin thinking about, getting ready for an exit. And I really like the Agora term of kind of transferable value, and not just the value you bring to your business, but what's going to kind of endure. And really positioning the business for that early on is critical.
Understand what success means to you. And I think it's a really difficult question, but it's such an important one. And it's multidimensional. It isn't just what's the number, right? It's what does this mean for my family? What does this mean for the things how am I going to spend my time, right? It's the emotional, the mental, the physical, and the spiritual nature of moving on from something that you've invested so much of your time and energy into. So what does success mean for you? And make sure that you're defining that before and as you're going through the process.
I think it's all about finding time and energy to take a step back and really think about your business from a third party's perspective. And if you can do that on a semi-regular basis, you're already, you've done the hardest thing, and you're going to put yourself in a position to maximize the value of your business.
And so as we transition to the next panel, I think this starting early, planning, we've hit on it from a estate strategy, how all of these actually tie together is just incredible. If you want to save on your legal expenses doing the transaction, make sure all of your legal affairs are done way in advance so that Nathan and team doesn't have to be cleaning it up and playing catch up later. As one client family says, it's just expensive to grow up. And so all of these areas of work and the intentionality that needs to be brought there, if there's one thought from today, really it is that planning aspect and getting out in front of it.